the week ahead. Last week, we said our message would be short, sweet, and to the point. This week is quite different. What I want to show you is really a contrast between momentum views of the market and structural views of the market that we get through using the market profile and market generated information. Following the election, we're all aware of the huge gap that took place. Following the gap, if you look on the graphic, you will see November 6th, and the market is straight up, followed by another gap, carries the market to new highs, while just short of the all-time high. The first thing to focus on is that on the 6th, there is no backing and filling. In other words, all you're looking at is price going straight up. There's no structure to that price. With no structure to the price, if the market begins to fall, it will probably go through there very quickly because there's no support levels along the way. The same is applicable to gaps as you have here. So now the market, we said last week, we actually thought the market would start to break down on Monday. That didn't happen. The market went a few ticks higher on Monday, and it didn't really start to give way until Wednesday. Late Wednesday, we started to see liquidation. That liquidation picked up on Thursday and made several attempts to fill the gap. Since traders were automatically buying the gap, which is pretty standard, it wasn't until after the market closed in extended hours that the market fully gave way, leaving us with another gap to the downside. As the market opened on Friday, first thing was that the odds were high that we would trade all the way back through 11.6, because as we pointed out, there was no backing and filling. In other words, there was no structure to the market. When there's no structure to the market, which would be, moving sideways to bring the market into some kind of balance before it proceeded higher, there's no support. The same is true for the gap. Now, the market, a substantial breakdown in the market. The market settled around the 5,900 level. A break of this magnitude, the odds are low that it is over, even if it is, because the break has been so great, you would expect that the market will need to come into short-term balance first. As we open Monday, the first thing we will do is focus on the 5,900 level. If the market can hold the 5,900 level, it may attempt to move back towards the upper gap. Failure to hold the 5,900 level clearly brings into play the 5,800 level, which would serve to close the gap. Closing that gap would be relatively significant because it was such a large gap. Emotions are high. I do not think the selling on Friday was the result of long-term selling or investment money selling. I believe that most of the selling that took place overnight on Thursday and during the day on Friday was related to hedge funds and other large trading accounts that were caught the wrong way in the market. And I say that because it's unlikely that the long-term money would be selling that quickly. But keep in mind that they usually, if there is to be liquidation, and I'm not predicting there will be by the longer term money, But if there is to be additional liquidation by investment funds, the market is often down another 6 or 7, maybe 8% before they really start to see that pressure. So as we begin the week, our first focus is going to be on the 5,900 level. Have a great week. Bye now.